All right, so you're looking to build a solid financial future and you're interested in investment portfolio diversification. Smart move. It's all about spreading your investments across different asset classes to reduce risk and potentially boost returns. It's like creating a financial safety net while still aiming for those big wins. To help us break down this essential strategy, I've brought in a financial expert who can shed some light on the intricacies of diversification and how it can work for you.
Well, let's be clear right away. Diversification isn't just for like Wall Street hotshots. It's a fundamental principle that can benefit anyone, regardless of experience or the size of their portfolio.
I like that. Breaking down the intimidation factor. Now, one analogy I keep hearing about diversification is the classic don't put all your eggs in one basket idea. But honestly, it sometimes feels a bit oversimplified.
Right. And while the analogy is a good starting point, it doesn't quite capture the full picture. Truth is, diversification is rooted in historical data and market trends. Let's look at numbers. Studies have shown that over the long term, diversified portfolios tend to outperform those concentrated in just one or two asset classes.
So you're saying there's proof.
Yes. For example, a study by Vanguard found over a 25-year period, a globally diversified portfolio had an average annual return of 8.8%, while a portfolio solely focused on U.S. stocks yielded an average of 7.8%.
Wow. So even a seemingly small difference in average returns can have a significant impact over time.
Absolutely. And that's just one example. There's a wealth of data out there supporting the power of diversification. Now, beyond the returns, let's talk about the psychological aspect. Think about how you feel when the market takes a dip. If all your money is tied up in one stock or sector, you're likely to feel a lot more anxious than someone with a diversified portfolio, where losses in one area might be offset by gains in another.
That makes perfect sense. It's about managing not only your financial risk, but also your emotional well-being.
Exactly. Diversification can provide a sense of stability and peace of mind, knowing that your entire financial future isn't riding on the performance of a single investment.
Okay, so we've established that diversification is key for both maximizing returns and mitigating risk. But let's get practical here. How does this actually play out during market downturns? Those inevitable periods of volatility that make even seasoned investors a little nervous.
That's a great question. It highlights one of the key benefits of diversification. Let's say the stock market takes a hit, as it inevitably does. With a diversified portfolio, you'd likely have some of your money invested in bonds. Historically, bonds have tended to perform well when stocks are struggling. It's this inverse relationship that provides a buffer during turbulent times.
So it's not about completely avoiding losses, but rather smoothing out the ride and protecting your overall portfolio.
Exactly.
So it's like having shock absorbers for your investments,
Yeah.
helping to soften the impact of market bumps.
Exactly. Diversification helps you ride out those market fluctuations, making it easier to stay invested for the long haul, which is crucial for achieving your financial goals.
All right, you've sold me on the importance of diversification. But where do we even begin? I mean, the world of investing can feel overwhelming, especially for someone just starting out.
Don't worry, you don't need to become a financial wizard overnight. The first step is actually quite simple: understanding your own risk tolerance. Essentially, this means figuring out how comfortable you are with the ups and downs of the market.
So it's not a one-size-fits-all approach. Someone who's saving for retirement decades from now might have a different risk tolerance than someone investing for a short-term goal.
Exactly. Your age, your financial goals, and your personal comfort level with risk all play a role in determining your ideal diversification strategy. For example, a younger investor with a longer time horizon might be more comfortable with a portfolio that's heavier on stocks, which tend to offer higher growth potential, but also come with higher volatility. Someone nearing retirement, however, might prioritize preserving capital and opt for a more conservative approach with a larger allocation to bonds, which are generally considered less risky.
Okay, so risk tolerance is essentially the foundation upon which we build our diversification strategy.
Absolutely. It's the compass that guides your investment decisions and helps ensure that your portfolio aligns with your individual needs and goals. Now, once you have a grasp of your risk tolerance, you can start thinking about the specific asset classes you want to include in your portfolio. This is where things get really interesting. We've already touched upon stocks and bonds, but there's a whole world of investment options out there, including real estate commodities and even alternative investments like private equity or hedge funds.
Okay, so it's not just about stocks and bonds. There's a whole spectrum of possibilities. But let's be honest, the thought of navigating all these options, especially for a beginner, can feel a bit daunting.
You're right, and that's why we'll break it down step by step. and explore different strategies for building a well-diversified portfolio that aligns with your risk tolerance and financial goals.
Perfect. Because I'm ready to move beyond the eggs in one basket analogy and dive into the real nuts and bolts of diversification.
Well, let's start by debunking a common misconception. You don't need a massive amount of capital to build a diversified portfolio. In fact, you can start small and gradually increase your investments as your knowledge and confidence grow.
That's reassuring to hear. But even with a smaller amount to invest, the task of picking individual stocks and bonds still feels a bit overwhelming.
I understand. And luckily, there are tools designed specifically for beginners who might not be comfortable picking individual investments, like index funds and ETFs.
Okay, those are terms I've heard thrown around, but honestly, I'm not entirely sure what they are or how they work.
Think of index funds and ETFs as pre-packaged baskets of stocks or bonds that track a specific market index, like the S&P 500. They offer instant diversification because they hold a variety of different securities, allowing you to gain exposure to a broader market segment without having to research and select individual investments.
It's like getting a taste of the whole buffet instead of picking just one dish.
Exactly. And the best part is, index funds and ETFs tend to have lower fees compared to actively managed funds, making them a cost-effective option for investors of all levels.
That sounds like a great way to dip your toes into the world of diversification without getting overwhelmed.
It certainly is. And as you become more comfortable with investing, you can explore other options and tailor your portfolio to your specific needs and goals.
This is all incredibly insightful, but before we get too deep into the how-to of building a diversified portfolio, I think it's important to address some common mistakes people make along the way, especially when it comes to diversification.
You're absolutely right. Understanding the pitfalls can be just as important as understanding the strategies themselves. One of the biggest mistakes I see is not diversifying enough. People might dabble in a few different asset classes, but still have a large portion of their money concentrated in one area, which defeats the purpose of spreading risk.
So it's not just about having a few different investments. It's about ensuring they're spread out effectively across different asset classes and sectors.
Exactly. A truly diversified portfolio considers not only the number of investments, but also their correlation to each other. You want to make sure that your investments don't all move in the same direction at the same time, which can happen if they're too closely related.
Okay, that makes sense. It's about creating a balanced and resilient portfolio that can weather different market conditions.
Precisely. Another common mistake, and one that often stems from overconfidence, is trying to time the market.
Ah, yes, the elusive art of buying low and selling high. Something I've heard is near impossible to consistently predict.
You're absolutely right. Even seasoned investors struggle to accurately predict market movements, and attempting to time the market often leads to more losses than gains.
Yeah, our source material is pretty clear about this. Patience and consistency are key when it comes to investing.
Absolutely. A long-term perspective and a disciplined approach are far more effective than trying to chase short-term gains.
So it's not about trying to outsmart the market, but rather about riding the waves with a balanced and well-diversified portfolio.
Exactly. Diversification helps you weather those inevitable market ups and downs and stay focused on your long-term financial goals.
All right, this has been an incredibly enlightening conversation so far. We've covered the what and the why of diversification, touched upon the importance of risk tolerance, and even started to explore different asset classes and potential pitfalls. But I'm eager to delve deeper into the practical steps of building a diversified portfolio. Can we dive into that in our next segment?
Absolutely. We'll explore specific strategies, tools, and resources that can help you create a portfolio tailored to your individual needs and financial goals.
Perfect. This is getting really exciting. I can't wait to share these insights with our listeners and empower them to take control of their financial futures.
Me too. Knowledge is power. And the more informed we are about investing, the better equipped we'll be to make sound financial decisions.
So stay tuned, folks. We'll be right back after a short break to continue our deep dive into the world of investment portfolio diversification. All right, welcome back. I'm really fired up to continue our deep dive into building a diversified investment portfolio. I'm already feeling more confident about this whole process.
That's great to hear. It's all about empowering you to make informed decisions about your financial future.
You know, we've talked a lot about the technical aspects of diversification, but I'm curious about your personal take on this.
Well, I can tell you from years of experience that diversification isn't just a textbook concept. It's a real-world strategy that can make a huge difference in people's lives. I've seen firsthand how a well-diversified portfolio can help people weather financial storms, reach their goals, and sleep better at night knowing their investments are strategically positioned.
It's so powerful to hear those real-world examples. It makes this whole concept feel more tangible and relatable.
Absolutely. And it's not just about the numbers. It's about the peace of mind that comes with knowing you've taken steps to protect your financial well-being.
Okay, so let's dive back into those practical steps. We left off talking about index funds and ETFs as great options for beginners.
Right. They offer a simple and cost-effective way to get started with diversification. But let's go a bit deeper and explore some specific types of index funds and ETFs that you might consider.
Okay.
For example, if you're looking for broad exposure to the U.S. stock market, you could look into an S&P 500 index fund or ETF. This would give you ownership in a basket of 500 of the largest publicly traded U.S. companies, representing a wide range of sectors.
So it's like investing in a slice of the entire U.S. economy.
Exactly. Now, if you want to diversify even further, you could consider an international index fund or ETF, which would give you exposure to companies in developed and emerging markets around the world.
So spreading your investments across different countries and regions?
Precisely. This helps reduce the impact of any single country's economic performance on your overall portfolio.
Okay, this is starting to make a lot of sense. Now, what about bonds? We touched upon them earlier. But how do we choose the right bond investments for a diversified portfolio?
Well, the bond market can seem a bit complex, but it doesn't have to be intimidating. A good starting point is to consider a diversified bond index fund, or ETF. This would give you exposure to a mix of government, corporate, and potentially even international bonds.
So it's like applying the diversification principle within the bond market itself.
Exactly. And just like with stocks, you can further diversify your bond holdings by considering different maturities.
Okay.
For example, a bond with a longer maturity date generally carries more risk, but also potentially higher returns, while a shorter-term bond is typically considered less risky but might offer lower yields.
Okay, this is all incredibly helpful. But I have to admit, I'm starting to feel a bit overwhelmed by all these options and decisions.
I understand. And that's why it's important to emphasize that you don't have to figure this all out on your own. There are resources available to help you make informed decisions and navigate the complexities of investing.
Yeah, our source material mentioned platforms like Fiverr and Upwork for finding affordable financial advice. Can you tell us more about that?
Absolutely. These platforms have become incredibly popular for connecting with freelance financial advisors who can provide personalized guidance and support.
So this is like finding a financial coach who can help you create a customized game plan.
Exactly. And the beauty of these platforms is that you can often find advisors offering their services at very reasonable rates, making financial advice more accessible than ever before.
It's like democratizing financial literacy, which I love. But how do you know if a freelance advisor is the right fit for you?
That's a great question. When browsing through profiles on these platforms, look for advisors who clearly state their qualifications, experience, and areas of expertise. You can also read reviews from previous clients to get a sense of their communication style and overall approach.
So it's like doing your due diligence before hiring any professional.
Exactly. And once you've identified a few potential advisors, you can schedule a consultation call to discuss your specific needs and see if their personality and approach mesh well with yours.
This all sounds incredibly promising. It's like having a personal trainer for your money, but without the hefty price tag.
Exactly. And with the gig economy booming, it makes sense that financial advice is becoming more accessible too. It's about empowering individuals to take control of their financial futures, regardless of their income level or experience.
I'm so glad we're having this conversation. It's really opening my eyes to the possibilities of personalized financial guidance. But before we wrap up this segment, I want to circle back to something we touched upon earlier, the potential pitfalls of diversification.
Right. Understanding the mistakes to avoid is just as crucial as knowing the strategies to implement. We already discussed the importance of diversifying adequately and avoiding the temptation to time the market.
But are there any other common blunders that we should be aware of?
One mistake I often see is investors becoming too emotionally attached to their investments. They might hold on to losing positions for too long, hoping for a turnaround, or sell winning investments prematurely out of fear.
So it's about finding that balance between being informed and engaged, but not letting emotions cloud our judgment.
Exactly. A disciplined and rational approach is essential for making sound investment decisions. Another common pitfall is neglecting to rebalance your portfolio periodically.
No.
As market conditions change and your investments perform differently, your asset allocation can drift away from your initial target.
So it's not a set it and forget it type of strategy.
Not necessarily. It's important to review your portfolio at least once a year, or even more frequently if there are significant market shifts, and make adjustments to ensure your asset allocation remains aligned with your risk tolerance and goals.
Okay, that makes sense. It's about staying proactive and adaptable in the ever-changing world of investing.
Precisely. And remember, diversification is an ongoing process, not a one-time event. As your financial situation evolves and your goals change, your diversification strategy should adapt accordingly.
This has been such an insightful discussion. We've covered so much ground, from the basics of diversification to specific investment options and potential pitfalls. But before we move on to our final segment, I want to take a moment to recap the key takeaways.
Great idea. Let's distill all this valuable information into a few actionable insights that our listeners can take away.
First and foremost, diversification is not just a fancy financial term. It's a fundamental principle for anyone who wants to protect and grow their wealth.
Absolutely. It's about spreading your risk, maximizing your potential returns, and creating a financial foundation that can withstand market fluctuations.
And it's not just for the wealthy elite. Anyone can start building a diversified portfolio, even with a small amount to invest.
Exactly. And thanks to resources like index funds, ETFs, and online platforms for finding financial advice, diversification is more accessible than ever before.
We also learned that understanding your risk tolerance is crucial for creating a portfolio that aligns with your individual needs and goals.
Right, it's the compass that guides your investment decisions and helps ensure that your portfolio is tailored to your comfort level with risk.
And lastly, we explored some common mistakes to avoid, such as not diversifying enough, trying to time the market, and letting emotions dictate our investment decisions.
Avoiding these pitfalls can make a world of difference in your long-term investment success.
This has been such an empowering conversation. But before we wrap up this deep dive, we want to leave you with a thought-provoking question. Now that you understand the power of a diverse portfolio, what's one step you can take this week to start building yours?
It could be as simple as researching different index funds, exploring financial advisor profiles on Fiverr or Upwork, or even just having a conversation with a friend or family member who's savvy about investing.
Remember, every journey starts with a single step. So take that step today and watch as your financial confidence grows alongside your investments.
And as always, keep learning, keep exploring, and never stop seeking knowledge. It's the best investment you can make.
Wise words. We'll be right back after a short break to wrap up our deep dive into investment portfolio diversification and leave you with some final thoughts. Welcome back to our final segment on investment portfolio diversification. We've covered a lot of ground today, and I hope you're feeling as energized as I am about taking control of your financial future.
It's been a fantastic discussion. I'm so glad we had this deep dive. I think it's going to really help some people.
You know, one thing that's really struck me is the importance of continuous learning when it comes to investing.
Absolutely. The world of finance is constantly evolving. New products, strategies, trends are emerging all the time. Staying informed and adapting is crucial.
Yeah, it's like a lifelong learning adventure, which honestly makes it all the more exciting.
Exactly. There's always something new to discover, a new strategy to explore, a new opportunity to seize.
And who knows, maybe one day you'll be the one sharing your investing wisdom with others, helping them build their own diversified portfolios and achieve their financial dreams.
Yeah, that would be great.
All right, so to wrap up, keep learning, keep growing, and keep diversifying those portfolios.
And as always, keep learning, keep exploring, and never stop seeking knowledge. It's the best investment you can make.
Wise words. Thanks for joining us on the Deep Dive. We'll see you next time for another deep dive into a topic that matters to you.